it's staying current. We do a good job on it. So.
And I think making sure that the farmer, the customer, understands when you're going to do that. A lot of times it's put on the contracts, just things to help you guys out, to back you up a little safer, which we'll talk about a little bit later as well. So, contract. Several meanings. Can refer to a futures transaction, or can also refer to a cash transaction. Example, sell 1 D's corn contract. Farmer might also sign a contract to deliver grain to a warehouse, or you guys might enter into a sales contract. So not that different on probably how you're going to use it, but a lot of times, another thing to remember when you're thinking about contracts is if you're talking bushels or contracts, 20 contracts is a lot different than 20,000 bushel. So keep that in mind. For somebody that maybe doesn't look at the market every day, as we start to work towards the conversations with farmers, a few useful terms that maybe are something that you've seen a wire again, or you want to talk to a customer about, are volume. What does volume mean? Where is volume heaviest? Where is the drive for the trade? Is it front month? Are positions already in a deferred month? Open interest. Existing unsettled futures contracts. This is kind of one of those things that, as we go into those deliveries, we're watching closely. How many contracts are still out there? What's the market anticipating is going to happen? And settlement. I'm not sure how you guys price I forget how you guys price spot grain. Is it off the previous day?
No, current days.
Okay, current day's close.
Yeah.
So that's an important thing to look at. The settled price. Bid ask, cover a little bit later, and I actually just kind of mentioned it right now. But one of the key things to look at while you're pricing or looking at a live market is, and there's not as much slippage today or spread, especially on nearby contracts, as there used to be. I remember this, and I highlight this because when I first started in 2007 as an assistant, about a week into it, I had a decent little chunk of money in an error trade, because the electronic volume was just starting to pick up. And it was, believe it or not, which doesn't seem that long ago, but it was really about the first 2 option months, Jeff, that really had any significant volume. And there was still a little bit of a spread where somebody's willing to buy it and somebody's willing to sell it. Well, if you put a market order in and to sell something, you're gonna get where somebody's willing to buy it. But you may see an ask price, oh, okay, that's what I really wanted, or last trade may have been somewhere a little higher. When I traded 1 crop year, so this was in March, and the guy wanted to trade December, so not that far off new crop, and there was a 5-cent bid ask on it, and I got executed, and he said, what the heck? I saw the last trade at this value, and you got me filled at this. So that's not as big of a deal today. There's actually pretty good volume all the way out into most contracts that are listed. But if you're buying grain, you want to look at that bid ask. It's not necessarily the last trade price that you should quote the farmer.
And we do run into this some still. We got an old boy hauls in down here to Canton, used to go to Warsaw some too, but he'll want to reach out and do 2016 deferreds or 2017 contracts, and you'll see a 2, 3, 4 cent spread on those sometimes. And so you got to make sure you let him know those types of things, and you do run into that some if you're looking way out ahead.
And many contracts, a lot of times, I don't know how many of those you guys trade, but okay. Just something to keep in mind, and especially in the deferred stuff. A few other terms, again, just kind of setting the background that you guys may hear. FOB, free on board. Memory trick to it is freight on buyer. If a sales contract, these are bushels picked up at a location. So in origination in a conversation with a farmer, maybe it's a FOB farm. If you guys are handling the freight, you guys do a little bit of that. Okay. Scott sells barges, he's usually selling FOB, the bank. CIF, cost, insurance, freight, the delivered price. So we look at SIF as New Orleans, basically. What's the basis? What's the SIF basis down there? Okay. Now, how many of you guys look at active quote screens in here? A couple, handful of you guys? Okay.
Most
Yeah.
Okay. And it's, you guys do live quotes, or is it some delayed, or?
There's a couple locations got delayed quotes.
Okay.
Most all of them have the bid ask and all those things on the screen. Most of them
Excellent,
do.
excellent. Wasn't kind of sure who we were talking to, but this is, this is an example of what we look at. And actually a little bit later we'll talk about quote fees and some of the changes in the markets. But price determination, for those of you that maybe don't look at it every day, what is the price of grain? Electronic markets versus open outcry, which the pits, as most of you guys know, are going to no longer be in existence on the future side of it. Last is the last reported trade. Bid is the price the market is willing to buy grain. Ask or offer is the price the market is willing to sell grain. What we just went through, limited volume can impact these prices. So, not a lot of slippage. A little bit there, maybe on a settlement on the July, but it's important just to remember that when you are quoting a farmer, what to look at. Bid price.
So the bid price, just to reiterate, and you've got your screen in front of you, the bid price is where we can definitely sell futures against that. So if our basis is 5 under, the bid is 385, the ask is 387, we know that we can get stuff hedged at that 385 level. So if you take 385, subtract our basis, we know that we can get 380 for that grain. We might be able to get 381, we don't know, the bid is 385, but when you see your market screen, you know that whatever the bid price is, that's what we can definitely hedge stuff off at.
I think our screens were buying off last.
Yeah.
Nate,
A lot
go
of them
back
have
to
last,
that previous
yeah.
screen. Sure. Yeah.
And a lot of the screens have last in the first slide, just like he has up there. And I would say, 80 to 90% of the time, it's not a huge deal, but it should already be on your screen. A lot of you that we use DTN, we use the instant quotes or even the delayed quotes with DTN. A lot of this will be up there, and a lot of them have last as the first column, which is what I have on my computer as well. But we know wherever the bid is, especially on new crop corn there, D's 15, the bid's 408.5, the ask is 411. We know we can sell, grain at that 408.5. That's not a.
What are people generally looking at on there? People aren't looking at the bid and ask in here.
No, mostly the last.
You're looking at really?
Last trade.
Look at the last. I think they're looking at the net change, right?
Well,
So what is it up? How are you looking at it, Larry?
the last and the net change go hand in hand.
Yeah.
So those are the two that the majority of the farmers look at.
Now the bigger question is, Larry, if I ask you that we're bidding $3 for corn and we're going off the May, tell me then what we're bidding today. Then if we're bidding at $3, what are you offering on there? Are you offering $2.95? Are you offering $2.96? What are you offering?
Well, usually when it's down, I'd go nickels. So I'd
that's
go
what's kind of
95.
tricky too. So if you
Yeah.
got a thin market and we're down 4.5, are we down 5? We down 4? What are we offering through there?
Depends if you guys stand over your shoulder looking. Well, actually, in Jerry's tenure, he had us going to,
Rounding
to the
down.
low side there.
Yeah, that's what.
Which
I did.
becomes important as far as what Nate and Scott are both saying. If it's a thinly traded market, if there's a difference between the bid and ask it's on there, it's really tricky for Scott or Terry to get that hedge off. So be careful how we're bidding things that's on there.
Right.
We're not taking it away from the farmer. We're just making sure our job's just the intermediary. We're going to buy it, and we're not taking a position. We want to make sure that we can hedge it off.
Right, and we, as we get into that, that's great discussion. We'll actually look a little closer at that this afternoon, but I think that, you don't want to change everything that you've done, but one of the things we'll talk about, done in the past, one of the things we'll focus on is technology, and I think one of the risks there is as farmers are getting text updates, or some have live markets on their phones, and that may not be everybody around the area, but it's it's definitely starting to transition towards that. So giving yourself a little cushion is fine. It really comes down to what type of contract. I mean, when I talk to my customers on origination stuff, it's, you know, does the farmer want a cash contract? Does he want an answer now? Hey, can you fill me today, right now, instantly? What price do I get? You know, make sure you know where you can trade it, and it may not be the last price. Does he want higher than that? Does he want to put an offer in? You know, all things that ultimately, I've always been a believer that you kind of, you know, you win some, you lose some on those type of trades, and I don't think it's the end of the world, but as you start talking bigger volumes, it's definitely that's a market mover. There's risk in that.
I daily get cash bids like from Cargill, and I see their bids coming. You know, I mean, they've actually got the cash quote in quarter, half, 3/4.
Sure.
I don't know. It always looks kind of cumbersome to me. I should try to deal with those increments on a contract or something.
I agree with you 100%. And that's really your guys' decision, and ultimately what the farmer, you know, I never liked, when I was at the elevator for 3 years, I never liked to use quarters and halves on my basis, you know, to try to make it an easy number. As a final bid sheet, I'd rather just bid them on the half, but use my basis as if they want, you know, 2,700, not 27 and a half. But ultimately, when I was quoting, I usually referred to just a flat, okay? You know, and hopefully that was a little bit on the downside. You know, if I took that half-cent cushion, your cash price of $3.80 or whatever it might be.
A half-cent slip on what we've handled so far this year would be about $160,000.
So I guess circle the wagons all the way back. Most of the people here are looking at, they might be looking at the last, but I think a lot of them are looking at the net change. And they're going to look at, is that a fair statement? What's people looking at when they're bidding grain?
Change.
They're looking at the net change. And I guess, again, making sure that we don't take too much of a risk position that's on here. And maybe we need to move into where our screen actually just quotes our cash bid, and it takes that away from the uncertainty that's in there. You know, we all have a tendency to want to try to buy the bushels, but just as Tim mentioned, you multiply any number by a number, or any number by a big number, it turns into a big number. We handle a lot of grain, and you multiply a half cent by all the corn that we're going to handle, and if we're on the wrong side of that half cent, it's a big number. So,
and the cash idea is I think a good idea, and we see more customers. And I'll show a screen of that later, but yeah, a lot of people, especially more farmers, again, as they become a little more savvy, they want to know the basis.
yeah.
You know, and for efficiencies, if you can have all that on one screen, your futures price, your basis, and a cash price, sometimes saves on a little bit of mathematical errors.
Which we do put in a lot of open orders. If the market hits a certain level, we get it hedged off, and that works good. It's good for the producer, and it's good for the elevator, and that we didn't take a position, and we didn't give up any potential margin.
So trading specifics on futures kind of ties into your quarter cent, half cent. You know, normally when you're quoting a farmer, like I said, I used to just try to make it a round number, but grain futures trade in quarter cent increments. 2 is quarter, 4 is half, 6 is 3/4. Minimum tick is on 5,000 bushels at a quarter cent is $12.50 a contract. So there's still a little terminology, but let's kind of start to transition forward and look at what all these contracts mean. What is the market telling us when we look at today's value and say you can trade March here, or you look at July's value and say you can trade July? Why does the market need so many contracts? Well, the goal of the market is to take a window, and sometimes that window is longer than other years, but the idea of a harvest window. Hopefully it's not a 4-month harvest, hopefully it's 2 months, sometimes stretches into 3 or less. And the job of you guys, of the warehouse industry, is to stretch that grain out for an entire year and feed it to the market when the market's telling you, pull it back off the market when it's not telling you. Sometimes we don't have a decision if we just don't have the space, and you just gotta put stuff in barges. the futures market is there to incent the holding of grain. Without a defined value on that grain in the deferred, there'd be a lot of risk on us just saying, yeah, we're going to buy it at today's value. And sometimes I think the farmer misunderstands this or does this, but cash is worth this today. If we didn't know what it was worth in 6 months, that's a pretty big risk to pay for something today. Agree we're going to own it and not know or have an idea of what we can do with it down the road. And so that's what we're going to start to get into a little bit here. And it's a pretty simple way to look at it. If the price of grain is higher tomorrow than today, then we want to be rewarded for carrying it. And what we need to do that is time, space, and money. And what that means in kind of a layman's terms, and as we're not going to get too much more into merchandising 101 on that aspect of it, but time is old crop to new crop. Logistics tie into time. How much time do we have to market that grain? Is the market an inverted market telling us to move grain today? Are we transitioning from old crop to new crop? So are we running out of time? Space, you guys know firsthand. You know, to really let the market tell you what you need to do, space is a key factor in that. There's ways to manage around it, and Scott did a great job this past fall with the space constraints or lack of space that you guys had around here. But we'll look at, to really, the stuff we're looking at to really allow market to tell you it's the carry, it's worth more down the road, you got to have the ability to store that grain. And then money. And that means, you're buying grain today from the farmer and you're going to carry it until summer or whenever the market's telling you to. You got to be able to pay that farmer for his grain. Interest rates are pretty low right now, so the money isn't as big of a factor, but that hedge position, that ownership that you have, you paid the farmer for, so you're likely borrowing money against that until you do sell that grain. So, like I said, the job of the market, the job of the futures market that we're specifically looking at is to tell the commercial, tell the warehouse, what should I do with my grain? Take that pile of grain, literally this past year from fall, and scatter it out over the next 7-8 months. So the warehouse industry acts as a reservoir of grain for the marketplace, storing grains in periods of excess supply and releasing grain during periods of demand. The market reflects these supply-demand imbalances through adjustments in basis, spreads, and price. As traders, as merchandisers, that's really what we're interested in. Strong basis, inverted spreads, meaning today's futures value is higher than it is 6 months down the road. Cheap freight sometimes incentivizes movement. A weak basis, on the other hand, carry in the spreads, low price, high freight, are probably incentivizing us to hold it. And that freight was a big part this last year. And freight, that was a new visual for me to see. I think for a lot of people to see barge freight go as high as it did. And we'll touch a little more on that, but it's kind of an interesting dynamic to see what freight can do in the market to create carry. And if freight's creating the carry, meaning my freight today costs this much, my freight in July is this much, that's carry, cash carry in the market if I were to go out and sell that. If freight's doing that work, maybe basis and spreads don't have to do as much work. So just something to kind of think through as we're talking through some of this. So the mechanics of hedging. We've identified contract terms. We started to talk about what the job of the warehouse is, and how we do that is hedging. That's why we hedge. We don't want to take flat price risk. We don't want to take the risk of buying something today and not knowing where we're going to sell it at in the future. We can sell it, we can back to back, but if we're going